Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. There will not be a return to normal after COVID-19, but the transition to what's next is underway. Joining me is Matthew Bartolini. He's the head of SPDR, Spider, America's Research with State Street Global Advisors, to discuss the Great Reset and what risk and opportunities present themselves to investors. Matt, it's great to have you back. Welcome to Trade Talk.
Yeah, great to be here. Thank you for having me on.
All right, let's take a look at some of the trends that you are looking at as we transition to the other side of COVID-19. And one of them is focusing on innovation and those segments shaping a post-pandemic future.
Yeah, so COVID-19 pandemic has created a new trend line for our society. Technological innovation will be at the forefront of reshaping our way of life. And in a more digitally connected world, it's going to require software to function. We see software and software services firms as the backbone of our new society. And I think, this represents, and the shift represents one of the reasons why we see earnings growth for software firms expected to grow by 18% per annum over the next 3 to 5 years, compared to just 10% for the broader market. And really, if we look over just the next 4 quarters, software services are not expected to see material declines throughout the rest of the year and into 2021 in their top line or bottom line. And so this really represents an area of growth because software will be that backbone. Valuations are a bit high, but a premium for a growth industry with the potential to reshape our society, I feel is warranted.
All right, and then Matt, when we talk about pursuing total return in the absence of income, this is something that we were talking about even pre-COVID-19.
That's right. It sort of exacerbated the search for income. If we look at the standard 60-40 portfolio right now, it yields the least amount it's ever had. And treasuries as a duration tool, they've become quite extended. Yields have fallen, duration is extended, and that sort of risk return is no longer there. So we feel that targeting segments that actually might have implicit and explicit Fed support may be one way to balance out that income and duration, or income and risk exposure in your fixed income portfolio. So mortgage-backed securities, short-term corporates, they're both going to be part of the Federal Reserve's buying program, and they also have a yields and duration profile that's attractive. So we feel that investors might warrant a strategy, if you say, around don't fight the Fed. So allocate alongside the Federal Reserve to sort of pursue a more balanced total return. And that includes high yield bonds, which credit fundamentals have deteriorated a little bit, but the Fed is a deep pocketed buyer of these risky bonds and doesn't really care about price or crumbling fundamentals. So high yield, even though it's risky, may have some sort of a ceiling in place if spreads do widen out because the Federal Reserve might be there.
Let's go back to growth and value for your third and final trend, because when you look for relative valuation opportunities, I think part of it is finding good value. There's a reason why some segments are cheap and lower in value. So when you look at relative value opportunities, how do you discern between the two?
So part of it is just looking at overall trends and behaviors. And I think what happened is that the pandemic has intensified the behavioral tendency of home bias, where investors favor domestic equities and ignore the potential benefits of diversifying into foreign equities. Outflows into non-US focused ETFs are at their worst point ever for any 3-month period. And meanwhile, multiples, valuations for companies outside the US are attractive. So we feel that as it stands right now, you could trim a portfolio's home bias by adding a bit more foreign exposure. It's a complete contrarian call, but it could be an opportunity if the regime cycle changes and valuations become too cheap to ignore. There's also other relative value opportunities if we think about it within the fixed income space, where inflation after the great financial crisis ran a bit higher given the stimulus, and we're having the same type of stimulative effects today. And back then, tips outperformed nominals in the years after. Given that the US break-even inflation rate's only 80 basis points, the recovery does take shape. Inflation is likely to surpass that level and possibly lead to stronger relative returns to tips. So it's really just trying to understand the trends, the valuation structures relative to others in that portfolio, and seek to eke out a bit more total return in a period where returns are going to be challenged because the future remains profoundly uncertain.
All right, Matt, great to catch up with you as always. Thanks so much for joining me on Trade Talks.
Thank you.
All right, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.